Well, I met Jim Farrish about 4 years ago at the World Money Show, and he quickly earned my respect because he teaches money management as he helps us to grow our money, our nest eggs, while always protecting the downside. Go to sectorexchange.com to learn more about what Jim does. His subscribers and clients are happy campers because they learn his methods and disciplines. As he says, know your entry, exit, and target on every play. My exclusive interview with Jim Farrish, Part 1, right now.
Meet top money manager Jim Farrish, founder and editor of Money Strategies, Inc. and Sector Exchange. Jim uses his strong math and investment background to help investors actively manage and control their downside risk while also seeking upside opportunities both with exchange-traded funds, ETFs, and with individual stocks. Follow Jim's advice closely if you'd like both you and your money to sleep well at night.
Well, Jim, let's go back to last summer, okay? The horrible summer of 2008. We talk to people all the time that lost 30, 40, 50% or more of their nest egg, of their 401k. What should they have done during that period to kind of lessen the losses, if you will?
I think the number one thing any investor should use in any portfolio is stops. The stops limit the downside risk of a portfolio because we don't know what's going to happen. I think really even in August, after all the news came out with the banks, nobody really predicted how far that would go down. I think if we had stops, we wouldn't have worried about it. We'd have been kind of wiping our forehead and going, thank God I'm in cash.
Now, whether you have a broker or a discount broker or a money manager, any of those things with stocks and ETFs, you can build in a stop, right?
Absolutely, yes. And if you're using a broker or even if you're doing it yourself, I would emphasize the use of a stop just to protect the downside risk.
All right, if I bought a stock at 40 bucks, where am I going to set the stop? 32, 35, 37? It's a little bit of a science and an art.
Exactly, and it's a little of both, and it's a little psychology as well. We tell people that there's no magic to setting stops. It's just the simple rule I use is how much risk are you willing to take with this asset? In other words, let's say I buy Microsoft today at $30 a share, and I don't want to lose more than 10%, then set your stop at 10% loss. If you're a technical analyst, use support resistance, use all those others. But find a discipline or a strategy that works best for your psychology.
Now, for people who don't know this area, stop the losses.
I have clients who own stocks, rode them up. I have one particular client rode it up to $3.5 million from a $100,000 investment and sold it for $125,000 3 years later.
Okay.
But you know, we get emotionally attached, and that's the point. If he'd had stopped, he would have protected maybe even $2.8 million of that.
Okay, whether I have a discount broker or money manager, kind of a financial planner, I can set the stop with that person or even with the discount brokerage.
Absolutely, and you can use a stop loss, limit stop. There's all kinds of things you can use, but a simple stop is the best place to start.
Yeah, a lot of people still have those old-fashioned investments we call mutual funds,
That's right.
There's still a lot of good funds out there. You can still set a stop with a mutual fund, but it's more psychological.
It's psychological and logical, really, because the fact that if an alert goes off one day, it says sell this at $10 a share, all you have to do is put the order in the next day and it goes off. But don't just hang on because somebody tells you we're in this for the long term or their 15-year track record is X. It doesn't matter. What matters is whether or not you can deal with the investment.
All right, so you'll have to set the stop yourself and execute it.
Exactly, and therein comes another challenge.
That's another challenge. And another problem that people have is not taking their profits. We see that all the time. A stock goes from 30 to 50 and they just sit on it. They don't take the profit. Then it goes back down to 40.
Exactly. And that's what we talk about, entry, exit, target.
Right.
We have disciplines that it was one of the things I learned a long time ago was define your entry, define your exit, and define your target. Well, if you buy a stock at 30, it goes to 50. When it gets to 50, that's your target. What are you now going to do with it? Sell half, put a stop at 48, do something that guarantees that you don't lose that profit.
People need this help, don't they? I mean, you're a professional, you're kind of a mathematician, money manager. People really need your guidance. You're kind of a tutor.
I look at it sometimes to get frustrated with people, but I have to step back and say, well, it took me 25, 30 years to learn this as an expert.
Yeah.
They're just now starting, so do it simple. Keep it simple, we call it, the KISS principle. And if you do it simply by saying, I'm going to get in here, I'm going here, and this is where my stop is, it's 3 simple steps that anybody can take and learn.
And you invest in ETFs, exchange-traded funds, which are stocks, but also in individual company stocks.
Correct. We start with the sectors. We look at, in the U.S. market, we start with the 10 major sectors. Then we drill down into 138 subsectors. And then if we want to own any of the stock in those sectors, we can actually buy the leaders within the group.
Jim, as markets being as volatile as they've been since the late 90s, do we have to now become both investors and traders, a little bit of both?
I think we do. I think more so than ever. I met with a client recently, and one of the comments I made to them is, after all the years that I did this, I started in the business in 1982, and by 1999, 17 years later, everybody was going, oh, you know, this works perfectly every time.
Yeah.
Well, what we found out in whatever we're going to call this decade of the 2000s, you know, it really is not that way. We had the correction of 2000, we've had the correction of 07, 08. It's really been a traumatic market for many people.
Well, we urge all of our viewers to go to sectorexchange.com to really see what you do. Next time, we're going to talk about something that you feel very strongly about, which is matching your money to your lifestyle goals.
It's the best way to invest. I mean, if you want to buy a new car, buy a TV, put your kids in college, whatever your objective is, it doesn't matter. You can travel, give to charity, it doesn't matter. But if you invest your money with a specific objective, specific lifestyle, you're a better investor.
Jim, I learned a lot today, and I'm sure our viewers did. Thanks so much for being here.
Thank you for having me.